What is accounting to you? Let's break the definition together. Accounting is a process of recording, classifying, summarizing, analyzing, and interpreting financial transactions for decision making by the users of financial statement. Who are the users of financial statement? In another video, we'll discuss what the users of financial information are. Now let's break this definition down like a real life journey, not just a textbook grammar. Number one, accounting is a process. A process means a step-by-step flow of activities. One stage leads to another, just like a cooking meal. Why does it matter? Why does the process in accounting matter? It matters because money moves every day and those movements must be tracked systematically. So if there is no process, there will be chaos. For instance, imagine running a palm oil business. You buy 100 rubbers today, sell 30 tomorrow, spend money on transport, pay staff salary or allowance, borrow money, receive credit customers. So if you do not have a process of tracking these activities, you will only guess whether you make profit or loss. And guess what? Guessing in a business is very dangerous to the growth of every business. Okay. Number two is recording. Recording of transactions. How do you understand the recording of transaction? This is where accounting starts. You write down every money-related activities as an accountant. Why recording? Why recording? What? Because the reason is very simple. What is not written down can be forgotten or manipulated. This is the essence of recording. For instance, you pay 200,000 naira for goods but forgot to record it. Later, when checking profit, it may look as if more money should be in account than it is in reality. Confusion begins to set in when there is no recording. So recording is a memory of every business. So meaning that every business that has no record, no records, has no memory. So if you are running a business or if you are managing an account of a business that your record is incomplete, there is no memory of that business. Number three is classification of transactions. Here, after recording, accounting groups similar transactions in a categories. Categories like sales, all sales put together, all purchases put together, all transportation expenses put together, and other groups of expenses and revenue. Classify them according to their group. So why the classification become important in accounting? It's important because it helps you to avoid missing different types of transactions, like missing salt inside garri thinking it's sugar. For instance, you keep record but mix transport costs with staff salary. At the end of the day or at the end of the month, you want to know how much you spent on transport expenses alone. You can't tell. Classification will help you to see where your money is going. Number four key point in this definition is summarizing. Here, accounting collects all records and present them in a brief, neat statement like trial balance, profit or loss statement, and balance sheet. Do you know why this is important? Why the summary is important? Because nobody has time to read long daily records. You need a summary that gives financial position at a glance, especially when the investors want to know the position of things, the position of their money, the position of the status of account in a business or in a company where they are investing their money. For instance, all the years you recorded over 3,000 transactions. Your investor want to know your profit. They want to know the profit the company is making. So if you start reading transaction by transaction, they will slip off. But one summarized income statement shows everything clearly. So the next point in this definition is analyzing. Analysis means checking the numbers to understand patterns. The patterns like profit trend, expenses trend, growth or decline. Why analyzing? Why the analysis? It is because numbers without meaning are just like ink on paper. Analysis turns figure into a very powerful insight. For instance, you have a summary that shows 1.2 million naira profit last year, while this year shows 800,000 naira. So analysis will ask you, where did the profit drop? Was it pricing? Was it higher transport? Was it low sales? Was it seasonal demand? This is where decisions start taking shapes. Number 6 is interpretation. Interpretation. So interpretation means explaining what the numbers are saying in real world language. What the numbers are saying in real world language. Why interpretation? The reason is very simple. Because not every business owners understand accounting terms. They want the message. For instance, after the analysis, you tell your palm oil client your expenses increased by 30%. Transport is the major cost. Transport is the major cost. So if we source from a closer location, profit will go up by at least 300,000 naira per month. Now the number speaks and decision get clearer. Number 7 is decision making. Decision making. This is the final purpose of accounting, to guide actions. Why decision matter? Because the aim of business is growth, not confusion. So if your record tells you you are running at a loss, you change strategy immediately. You change strategy immediately. So if your margin is high, you scale up. For instance, after interpreting financial performance, you can decide to do the following. Number 1, you can decide to increase the selling price. You can decide to reduce transport costs. You can decide to buy stock in bulk. You can decide to hire or reduce staff. You can decide to seek more funding. So accounting becomes your compass when everything are in place together. Okay, so accounting is not just a figure, it is a step-by-step process that track money, organize it, summarize it, study it, explain it, and finally helps business owners to make a better decision as far as their business is concerned. So it is like being a financial doctor. You diagnose money movement, and prescribe business decision. So that is what accounting is all about. So until I meet you again in my next video, bye for now.